This is Chapter 6. We're going to talk about merchandising activities. We're going to contrast that with manufacturing activities. And so let's jump right in. There's many merchandisers out there. A good example might be Walmart or Target or Amazon, or in this case Lowe's. Lowe's is a home improvement store. And there's about 2,000 of them throughout the country, and I assume throughout the world. They carry a wide selection of national name brand merchandise, and so they don't manufacture them, but they get them from others. They also have their own private brand, and so where they can sell these items maybe a little more generically, and they offer both name brand as well as their private brand products. Typically the private brand products they can get a higher margin on, and so they're likely to promote those where possible. These financial statements are similar to other organizations that we've used in chapters. However, the way they account and show inventory might be different than other companies, especially comparing merchandisers to manufacturers. So merchandising companies sell products rather than offering service. They purchase products from others, national brand or private brand, and then they have them available for sale. They've got to get those products there, got to display them, they've got to put them in distribution centers, get the right product at the right price at the right time, and so forth, so getting those available to sell. Retailers sell merchandise directly to the public. We had a few examples, but Lowe's, The Gap, Walmart, others, Nordstrom's, for example. Gas stations, convenience stores might also have them, typically more in small business form. Wholesalers are ones that buy large quantities of merchandise from multiple manufacturers and then resell them. Typically, wholesalers will sell to businesses rather than direct to to consumers. Typically, they're going to call this, or at least used to call it B2B, business to business, rather than B2C, which is business to consumer. So that would be an example of wholesalers. Now, inventory for a merchandising company is going to be purchased and then held for resale. And so they're going to buy these and acquire, display, and sell them as efficiently as possible, and they'll be included on the balance sheet as a current asset under inventory. So the key point here is that for major retailers and wholesalers, inventory is one of, if not the largest, one of the largest assets on the balance sheet, as well as its cost of goods sold would be its largest expense on the income statement, because they are simply reselling. Now they have what we call an operating cycle. An operating cycle we refer to as typically cash to cash. So when is cash invested, when is cash received, and that process is called the operating cycle. It includes purchasing, selling, and then where applicable, collecting those receivables that are owed to them. An illustration of that is shown in this diagram where we invest in inventory. Sometimes we'll sell that on account or for cash directly, and then we'll collect those receivables. And if receivables aren't part of the process, it's inventory straight back to cash rather than going through receivables. So manufacturing entities or companies are a little bit of a compare and contrast. So General Motors, a company like IBM, perhaps Boeing, that makes aircraft, would be an example of operating cycle, and that would be a longer process where they're actually manufacturing the goods. It might take Boeing beyond a year to make a 787 or other type of aircraft, and so they're holding that in inventory for a long period of time. The operating cycle of a manufacturing company is typically longer, typically more complex than it would be for a merchandiser. And so we're kind of comparing and contrasting those here. A service company might have revenues and they perform the work, and that creates net income. But For a merchandising company's income statement, it's going to include a process of cost of goods sold and then gross profit less operating expenses. And so you can kind of see the difference between these and what they might look like. So for a merchandising entity, again, they're going to have a cost of goods sold. They're going to have their various operating expenses. They've got to pay their employees. They've got to advertise. They've got insurance, utilities, and so forth included there. As far as our income statement terminology, the cost of goods sold is the cost to acquire the merchandise sold. And we'll have a line called gross profit, sometimes gross margin is what it's called. Sales less cost of goods sold. And then anything below that would be an operating expense. And so that net income results, you'll only have an income if the gross profit is greater than the sum of its operating expenses. So you can kind of see what that looks like there. So let's read this. Assume you are an inventory manager for the largest store owned by Computer City. You are very busy one day when Fran Thompson, CPA with accounting firm employed by Computer City, arrives and requests your assistance in helping understand certain control features of your company's inventory system. This includes the physical flow of inventory into and out of your warehouse, trying to understand how it comes in, how it goes out, how inventory is recorded, how the inventory is safeguarded, so it's not stolen or doesn't, go bad, right? Or doesn't get out of date, obsolete, and are frustrated by the lack of notice that the auditor was coming today. What should you do? Well, typically it's important for them to understand this process. I mean, granted, they probably should have told you that they were coming in advance, but this process of really understanding is critical for establishing controls and understanding the accounting process. So typically manufacturers sell their products on account and allow customers typically 30 or 60 days to pay. And frequently these sellers will offer a discount because they'd like to get their cash in quicker. And so they're going to have certain terms. A common term would be 210 net 30, where you get a 2% discount if paid within 10 days, where the net or the rest is due within 30, and in that case they do not get the discount if it's after that initial 10-day period. So the discount period is when the discount's available, and in this case it'd be in the first 10 days. And so this discount period is a period during which the discount is available, and sometimes this will be called a cash discount. And so typically a company would want to take advantage of that because the big discount is worth making the effort and giving up the cash on a timely basis. Recording those purchases would be shown as follows. So let's say November 3rd, Computer City purchases 100 spreadsheet programs for $100 each from PC Products, and they're given terms 210 net 30. So it's going to be recorded at the gross price. And so we're going to act as if we have taken the discount. So $100 times 98%, because we're planning on taking that, and it's 100 units, so $9,800. And so this would how it be recorded as if we had taken the credit. But then if we forget or we don't make that, we're going to now have an expense-like item, purchase discounts lost, that will be recorded as an expense because we did not take advantage of that. And so you can see how that's recorded. The other way to record it is recorded at gross invoice price. That is going the other way and saying, hey, we're going to record this, and then if we do take the discount, then we'll record that as if it were a net revenue. And so first we'd say 100 items, $10,000 worth, 100 at 100, so it'd be 10,000 on terms 210 net 30. And then if we actually take it in time, we're going to go ahead and reflect that as purchase discounts taken for $200 because we took the purchase discount. That's 2% of 10,000 would be $200. So you can see they get to the same place. They just recorded a little bit differently. What happens if we return the merchandise? That is, we take it back and say, hey, maybe these items were good, maybe we don't need them anymore. We're going to go ahead and reverse that entry and reduce accounts payable, reduce inventory as if it had never happened. Now we do have something called the subsidiary ledger. And the subsidiary ledger is where we keep track of the details. So they may not be in the general ledger where every time we're booking a journal entry, but this might be, hey, we might have thousands of transactions associated with inventory if we're a merchandiser, and we're going to use a subsidiary ledger to reflect that. Any transportation costs relating to the acquisition of inventory are not expenses of the current period. They're going to be included in the cost of inventory. And so you can just say, okay, that's part of inventory. It's not separately an expense. It's just part of the asset. So like inventory is an asset, transportation in would be an example. It's included in the cost of goods sold rather than separating costs into those related to inventory and having an expense. So that's the key point associated with transportation. So assume you are in charge of purchasing. You're currently making decisions about the purchase of outdoor furniture for sale during the upcoming summer season. You must decide how many to buy. Describe the types of accounting information that would be useful to you in making these decisions and where this information might be found within the company. Well, that's a good question. We might be interested in how many did we purchase in the past? Did they sell? Did we have to return some? How much did they cost before? How much do they cost now? What's our expected markup? These would all be questions whether it makes sense to purchase or not. We don't want to buy hundreds and double of what we bought last year because we probably wouldn't be able to sell that many, and especially if the price went up. So these are questions that we would naturally have. So transactions related to sales, we're going to have sales less sales returns and sales discounts. Okay, so if we sell $912,000 worth of product, but we give credit, some came back, were returned, others we offered a sales discount for, and so we're going to report net sales. And so anytime you're going to see this on a income statement for a merchandiser, you're going to see net sales, and that's going to be net of sales returns and allowances and sales discounts, and we can see that definition here. So now let's go a little bit further and see what they are. So as an example, on November 5th, Highlander Pub returned 1,000 of unsatisfactory merchandise to Computer City. Computer City's cost for this merchandise was $600, and so we're going to go ahead and return that. And so the question is, how do we record this? And Computer City, so sometimes the question is who here? And in this case, it's going to be for Computer City. And Computer City is going to say, hey, some of those sales were returned, and now they don't owe that $1,000, and it cost us $600, so we need to say reverse the cost of goods sold in the inventory that reflects the reduction in inventory costs. The next one is going to be sales discounts, and like purchase discounts, we're going to give terms now to someone else. Earlier on, a few minutes ago, we were talking about purchase discounts. Now we're giving sales discounts, and that is to our customer. And so we can see what that looks like here. And so we sold something for $1,000, and it looks like they took advantage of the 2% discount because they had terms of $210 net $30 as reflected here. So they took 2% of the $1,000 and took a discount. And now we're going to reduce the accounts receivable because payment was made by giving sales discount and the cash payment. So we see what that looks like. All right, delivery expense. Now we remember transportation in is part of the inventory cost and ultimately through cost of goods sold. But delivery expense is separate. It is a separate expense and is not part of cost of goods sold. And so that's some compare and contrast. And I think of transportation in included. Transportation out or delivery expense to take it from our sales floor to the customer is going to be included as a delivery expense. And so that's some some specific treatment that might be afforded. Now, accounting for sales taxes. We owe sales tax. We collect that sales tax and then remit it or pass it on to the government. And so, though the sales were just $1,000, we also collected $70 in tax. And so we received $1,070, but we still owe that. That is not ours. We owe that to the government, and so we need to pay that. Now, we want to talk for a minute about some special journals. And so let's talk about these special journals and what they might look like. 2-column journal entries are ideal for text. That's how we do it here. We show you that kind of line by line what the journal entries look like. But special journals will combine identical transactions. So let's say we had a sales journal, and the sales journal just reflected sales. That's all it ever reflected was sales. And then we take the total at the end and push that to the general journal. And so, but we're going to have like transactions be recorded in a like manner. Okay, the other thing we want to talk about is subsidiary ledgers, so control accounts. And these control accounts are used to prepare financial statements. We actually talked a little bit earlier about an accounts payable subsidiary ledger or an inventory subsidiary ledger where we're keeping track. And so, for example, who owes us money? That would be an example of an accounts receivable. And so we're going to have details on everyone who owes us money. Or who do we owe money to? That would be an example of the accounts payable subsidiary ledger. Notice they're subsidiary to the overall control account. So at the end of the period, we sum them up and make one journal entry or one reflection of it within the control account. And that just helps us to effectively manage our business and keep track of some of those details. So these subsidiary ledgers are examples used within merchandising companies. They could be used in manufacturing, but if we have 500 customers that owe us money, rather than keeping 500 individual records, we're going to keep them collectively in accounts receivable balance. So computer systems help us with this and help us reflect those transactions. The inventory subsidiary ledger, that's going to help us keep track of the detailed inventory. There are so many possible, we call them SKUs, stock keeping units. And let's say there's a Snickers bar and there's a snack size and a Snickers bar and it's full size and a Snickers bar that is super size but each of those are SKUs that they're separately kept track of. And so to keep track of all of that detail, we're going to use a subsidiary ledger. So the advantages of special journals is we can record them faster, more efficiently. We can go and find them, and we might use many of them at the same time. We mentioned automation, recording a lot of these in a computer system makes it easier, and even employees may not need to know any accounting. Just say, hey, if it's a sale, write it down here or make sure it's reflected in this computer system. But you don't have to know the overall accounting process in order to do that. So typically this is done automatically, done by computers, but we're going to take advantage of those special journals. Now, in reflecting and perform our financial analysis, we're going to want to know how sales change over time. And so we want to know, are we selling more per store or less? And so sometimes you're going to hear in the news, same store sales increased by 3%. And so that just says, hey, if the store has been open for a year, how much did that change? We're going to also want to know the net profit margin. Remember, profit margin or gross profit all mean the same thing. Even gross profit margins means the same thing. But essentially we're saying, hey, after cost of goods sold is paid, the cost of acquiring them, are we still profitable? And is that going up or going down? And is it higher in some departments or some divisions versus others? And so that we can make important decisions. So that concludes this lecture.